All right, Quentin, if you want to go ahead and get us started, and thank you for joining, everyone. I'll have Quentin take it from here.
All right. Good morning, everyone. My name is Quentin. I am one of the wealth managers here at KWB, and I'll be moderating today's webinar. I want to thank you for joining us for our 2021 Economic Outlook. And before we get the discussion going, of course, we have the usual business items we need to take care of. So coming up on the screen here is the slide that makes the lawyers and compliance team happy. We will be recording today's presentation. So in case somebody might find the information of value, or you want to go back and look at it another time, we will be sending out an email saying that the recording is on our website at a later date here. We will be taking questions at the end. To submit your question, there's a Q&A box at the bottom of your screen. You just write in your question there, and then at the end of our discussion today, we will go through those questions and get them answered for you. And as you entered the webinar today, there was a poll question for you with 2 questions there. Again, at the end of the presentation or the discussion, we will go over those polls. So enough of the business items, let's get on to the fun stuff. So like I said, my name is Quentin Bubb. I am a wealth manager here for going on almost 6 years, and I will be moderating today's event. We have Carrie Bubb, our founder and chief wealth manager, on the panel. Robert Bullock, chief wealth manager. He's been with the firm since 1996. He's out in our Monrovia office. We have Mike Razuk. If you're looking for some detailed analysis on Social Security, he's your guy. He's been with us since 2007. Then there's Igor Nikochin. He's been with KWB since 2018. He's working on a CFA. And if you've spoken with your advisor about our KWB thematic model, Igor's had a big play in that. And then behind the scenes, whose voice you've already heard, that is Rachel Bubb. She's a wealth manager as well. She's been with the firm since 2018. And she's just going to help kind of make sure everything goes smoothly here as we talk about 2020 and what's going on for 2021. All right. With that, when we get started planning our economic update events, it's always a struggle to decide what topics we should talk about, because what's top of mind and important today might not necessarily be that tomorrow. And 2020 proved to be no different. And it also kind of, in a way, made things harder. It was quite a historic year with the pandemic, the social injustice protests, and while there are pieces of the year we will never forget, or we will forget, there are pieces that we will never forget, like toilet paper disappearing from store shelves as the pandemic became a reality. So to get us rolling here, Carrie, can you kind of bring us in on what 2020 looked like and some of maybe the key things that we learned from the year?
Yeah, hey, thank you for that introduction, Quentin, and thank you for all of you tuning in, and hopefully you find today's thoughts insightful for you. So one of the things that I think back and look at is I almost compare September 11, 2001 to some degree to maybe the year 2020. For those of you, and most of you are on this phone that do recall, on 9/11, you recall typically where you were and what you were doing the moment you heard the World Trade Center had been attacked and the Capitol and all the other things that were going on at that point in time. And you remember what you were doing. And you'll probably always remember that the rest of your life. Many of you may not have lost somebody that you know, but when you look at 2020, it's going to be similar in that this is the year that you'll look back and remember, boy, the times we had to postpone the wedding event, or we had to maybe cancel our vacations, or homeschooling for our kids. And boy, what a hectic year that was when everybody was fighting for the home office and the internet. Maybe no prom, drive-through graduations, no eating out. So 2020 for many of us will probably be remembered in those kind of similar things, the things that we encountered. And for most of us probably on the call, we haven't been majorly economically impacted, but certainly we've been inconvenienced. and we begin to appreciate all the things that maybe we used to do and take for granted. And I'm sure most of us are looking forward to be able to throw away that mask, get on an airplane, take a cruise, and enjoy life the way we used to do. So when I look back, what I think of is about a year ago, I was sitting in this office talking with clients, either virtually or most often in person. And we would have a discussion about the economy in 2020. And mind you, in 2019, we had gotten off to a pretty good year. Markets up, I think, 18 or 19%. And what I had said in the beginning of January of 2020 is, as I looked forward, I didn't see a recession in sight. The economy was growing, albeit maybe a slow 2 to 3%. Interest rates were low, inflation were low, unemployment was low. Earnings were growing, and everything looked okay. And the reason I said 2020 would be okay is because if we didn't have a recession, then there's an 80% chance the markets were positive. So I kind of ended on, no recession, markets up at the end of the year. Well, I got half of it right? The market was up pretty good in 2020, up about 15, 17, depending if you count dividends reinvested. But boy, did I get the first part wrong. In March, we began the significant downturn of the economy as COVID-19 really became impactful into our economy. And the S&P fell about 35% in about 30 days. Unemployment numbers went from maybe low threes to almost 25%, numbers we hadn't seen since the Great Depression. And what that cemented for me was, in the short run, the market, the economy, very, very, very difficult to predict. And even if you look at the last 11...
Kerry,
Sure,
it's Bob. I wanted to show just a quick chart, sort of highlights some comments that you had just said, that shows the volatility in the markets. And as you highlighted, it's not easy to make money off of investing in stocks and bonds. This goes back to 1980, 41 years of investing. The dots show each year how big of a drop that you had to sit through, and the bar shows each year if you didn't do anything as to what the market actually ended up, what the performance was. And to the far right shows 2020, Kerry, that you just highlighted. At one point, the market was down 34%, but if you didn't do anything, by the end of the year, you actually made 16%. And so 31 of the last 41 years, you made money. But on average, you had to sit through about a 14% drop each year. That's not easy. And so the strategy, as Kerry would tell clients, and I have as well, is not only to think long-term, is to act long-term. You got to stay in, even when it gets difficult at times. Don't watch the markets if you can, and diversify with bonds for a smoother ride, and maybe have some extra cash that if you are going through a difficult period, maybe you can reduce your withdrawal or even use some of the cash you have in savings and checking. So, Kerry, I just wanted to put some numbers to a chart just to highlight some of the comments that you made.
Yeah, absolutely, Bob. And even if you look a little bit shorter term in the last 11 years, which doesn't seem like that long, but actually is, we have had 6 periods where the markets declined more than 10% during the year. We've had 2 periods in the last 11 years where it declined more than 19. We've had 1 period, the one we just spoke of in March, more than 35%. And even in the last 11 years, if you'd just left things alone, you'd averaged about 11%. So what I want to reiterate is in the short term, things are pretty unpredictable. But one thing I always focus on, and I say this often, is, at the end of the day, mankind moves forward. When we wake up tomorrow, we're going to be thirsty. We're going to drink another Pepsi. We're going to ultimately want to take our kids to Disneyland when maybe Disneyland reopens. We're going to buy a new home. We're going to want to remodel that kitchen. We're going to take that new cruise or that vacation. We're going to see our grandchildren, and we want to be a part of their life and get them educated, and hopefully they'll have a better life than we did. So, the companies that are going to thrive are the companies that take care of our needs in the future. And I think that part of the economy is very predictable. Over the long run, companies are going to thrive by trying to give the services and the products that we want as citizens and as people. And if we invest in those and kind of ignore some of the short-term unpredictability, like who could have predicted the terrorist attack in 9/11? Sure, maybe we had some inklings about things going on, but that day, that way, with the World Trade Center. And who could have predicted COVID-19 at that time and the impact it would have had on our economy when it was just started in a little place in Wuhan, China, and moved 10,000 miles across the oceans and killed over 420,000 United States citizens year to date. So again, long run, markets are very predictable. Short run, not so. Don't even try, and just take that long-term approach.
Thank you, Kerry and Bob, for those comments. We've learned or have been reminded of many things in 2020 when it comes to the market. But now we're in 2021. And in January, we had the runoff election in Georgia, which brought us the Democratic sweep. The last time this happened was in 2009 to 2011 when Obama was in office. Kerry, should we as investors be worried about this Democratic sweep?
Right. Well, I've had a few emails, and this was back in the Trump era and also today, more recently with the Biden era, where many people are quite concerned about that. And I personally think there's too much attention or focus on maybe who is the president, and it doesn't really impact the economy as much as you might think. And the first question I guess I have is, well, was it a sweep? I guess numbers-wise it was. Biden is a Democrat, won the presidency. In the House, though, the Republicans actually picked up a few seats. In the Senate, yes, they lost a few seats where we have, basically 50-50. And if there is a tie, well, then, of course, Kamala Harris, the vice president, will have the tie-winning vote, and most likely she would vote Democratic. But they don't have a super majority where they have just go do whatever you want to do. It's still going to be difficult for Biden to get through some of the legislation he's wanting to get through. And I think it's more about timing. It's about what happens in the world that the president has to deal with. Whether it's a disease, whether it's a war, whether it's terrorist attacks, all those kinds of things. And if you think back to even Bill Clinton's presidency, and here's a clue to the answers here as we talk about that first poll question. From 1993 to 2001 was Clinton in office. We basically had no wars, and things were going along pretty good. We even had a surplus. We had so much money we didn't know what to do with it, and the internet was going full bore as we were preparing for Y2K. Well, then Bill Clinton leaves office and comes in George Jr. Bush, and almost immediately he has to deal with the tech bubble. And just 9 months later after that, or 8 months, he has to deal with the World Trade Center attacks and the terrorist attacks. And then if that's not enough, about 4 or 5 years later, or 6, he has to deal with the financial crisis. So a lot of things that happened under George Bush didn't really start under him. He didn't plan the tech wreck. He wasn't there. He didn't, know about or could stop the possible terrorism in 2001. He'd only been president for maybe 8 months or so. And then comes along Obama in 2009. And really, at the bottom of the financial crisis, and he's in office, he does a lot of great things. The economy rebounds. Markets up almost 182%. And then more recently, Trump comes in, kind of extends maybe the Obama rally, the economic cycle. He's no longer president, probably because of maybe the COVID and many other things that he did. But nonetheless, the markets were up 67% during Trump's, 4-year term. So I think too much focus is on maybe, the makeup of the party. Is it Democratic or Republican? And on average, it just doesn't matter. It's more about investing and being long-term, and you shouldn't get scared off by a Democratic sweep. And one last thing here is Biden takes over. Biden could go down in history as a great president. If he has these vaccines now and he can get them out to the public, we have an economy that's been suppressed because of government closures and all kinds of things. Boy, if we get the vaccine out and people are able to travel and go about the country again, you could see this economic outlook and this economy really, really prosper. And of course, he's at the right time. He would be the one likely to get the credit, even though maybe he wasn't the guy that pushed for the vaccines in the beginning. So great. I think lastly, I think we're also more often seeing a shift from, bigger government, more government to less government, so we're seeing maybe about every 8 to 10 years, the dynamics of the politics changing much more rapidly than what we had seen maybe in prior generations. So don't rest too much of your thoughts on who's president and how it's going to impact the markets.
Great. Thank you, Kerry. So as you pointed out, each president inherits their own kind of, situations going on in the world and the country. Biden's kind of inherited the coronavirus and the issues there. And with the changing of the guard last week when Biden was inaugurated, we kind of saw his changes, his plan as far as, reopening the economy, his thoughts on it and the vaccine. And now we have, a number of viable vaccines out there, and hopefully as those get rolled out faster, the economy can reopen. So Igor, where are we in this reopening process of the economy?
Right. Thank you, Quentin. Great question. So the economy has been reopening, actually. People tend to think it's either open or closed. And if we could pull up the next little animation, I'll show you where we were in the summer of 2020 when the restrictions and the lockdown just began, with the red signifying that there's less than 20% of the businesses open. So majority of them pretty much closed. The light green and the really bright green, that's 60 and 80% open respectively. So you can see that throughout the second part of the year in 2020, the economy has throughout the globe been reopening, specifically in Europe and closer to the end of the year in the United States. Even though it may not seem like it to us here in California, where the restrictions are just starting to be lifted a little bit. The domestic travel in China has reached prior peaks, which is a good sign that the US is to follow if the vaccines are successful and if we continue to reopen in the same rate that we have been. So that's some more good news. In addition to that, there are millions of vaccines, and we'll talk more about this in a moment, that are going to be released in the next 100 days or so. And lastly, on a more economic side, the US manufacturing data as well as global manufacturing data has really picked up more than analysts expected for a recession having occurred this year. So things are picking up, the economy is reopening, and hopefully if this trend continues sometime in the mid-summer or late, maybe third quarter 2021, we'll see things start getting back to normal. So thank you, Quentin.
All right, thank you, Igor. So you've shown us that the economies are reopening and the vaccine will likely help speed things up. Mike, what does Biden's economic stimulus plan look like, and how might it help get things going alongside the vaccine?
Good question, Quentin. So just a little context before I jump into what's under the hood here. So in December, we saw hiring around the US fall for the first time in about 7 months. And we saw weekly jobless claims jump to nearly 1 million just a few weeks ago. When polled by credit agencies, 6 out of 10 households say that they're still facing financial hardships. So there's still a lot of need out there with just regular American households. So part of the proposed bill from Biden and his team is about a 1.9 trillion stimulus plan. They're calling it the American Rescue Plan. So lots of different parts to it. Most importantly to the average American is direct relief via $1,400 checks. So that's something that they're hoping to push out mid-February, maybe even mid-March. The goal is trying to get about $3,500 in Americans' hands as a household. So when we look at this, it's a phased-in program. They're basically trying to get a full $2,000 between this stimulus check and the one that was done in December. And basically a household with a single person under 75,000 would get the full 1,400, and then it starts to phase out over that. With a married couple, under 150,000 of household income would get the full $1,400 check. So that's the first part. The other part is an expansion of the child tax credit. It's currently at $2,000 per child. They want to actually double that, take it up to $4,000 with a cap of 8 if you have 2 or more kids. So it would be a refundable credit, which means that if somebody doesn't actually owe taxes, they would pay it out as basically an extra stimulus. So we're trying to get direct relief in the hands of Americans who need it. Another part of the stimulus proposal is enhanced unemployment benefits. So we've seen this number kind of jump between the last stimulus plan and the first one. So we're seeing a proposal of $400 a week initially. So it was $600, and then it went down to about $300, and now the proposal is $400 a week in additional unemployment benefits. There's also proposed funding to open up K through 8th grade schools within the first 100 days of the Biden administration. So good news for parents out there. There's $35 billion recommended for grants and loan programs for small businesses. They're actually hoping to lever that up to about $175 billion. And then this is something that's kind of unique to this proposal. $350 billion in emergency relief funding for state and local governments. So we've seen lots of big states with cash flow issues. This is supposed to help, expand vaccination programs in states and just take care of cash flow issues that many states are facing at the moment. And then finally, 160 billion proposed to expand federal programs for the vaccination and for testing centers. So really getting more vaccines in the arms of people. So that's what's in the 1.9 trillion. Another thing that Biden has proposed, though, is actually increasing the federal minimum wage. So the proposal at the moment is $15 an hour, and that's up from $7.25 an hour. So pretty significant jump potentially.
Great, thank you, Mike. You listed off about 6, 7 things there that are part of the stimulus package that Biden would like to get pushed through. It sounds kind of like a heavy order. We're currently in that first 100-day window where things in the White House are going like cabinet picks and whatnot. And many presidents are judged on how they do and what they do in this first 100 days. Mike, what does President Biden plan to get done in this first 100 days?
Yeah, it's a really interesting question. And this is going to be a pretty unique set of circumstances. So Biden coming in has a pretty big juggling act. On one hand, he's trying to deal with the pandemic. He has to do stuff that, is going to be respectful of a fragile economy. And at the same time, this is the first time that we've seen this, the Senate's dealing with an impeachment of a former president. So, their time is going to be split between that and trying to get cabinet confirmations. So lots of coals in the fire here, so to speak. So I think first thing, Biden does need to accomplish is get that cabinet confirmation. We need to know who's going to be, steering these ships in the right direction and who's going to be in charge of these different programs and government agencies. I think next, it really is going to focus on the passage of a stimulus bill, again, just trying to help provide direct relief to the Americans who need it. After that, I think we're going to see the continued expansion of the vaccination program. So Biden has put he's put a goal tangible of 100 million COVID-19 vaccinations within the first 100 days. So, he really is trying to expand that program by putting federal sites out for vaccinations, getting mobile vaccination centers out to rural areas. So lots of expansion on the vaccination program. Additionally, lots of executive actions. We've already seen over 30 pass. And so these are going to include things like the extension of the pause on student loan payments, the extension on the eviction moratorium. So I think that proposed is to go out until March 31st of this year. We've seen the reversal on the travel ban of several foreign countries, mandate to wear masks on federal property and when traveling interstate, so on airplanes, public transportation. We've seen the rescission already of the permit for the Keystone XL pipeline, and then the ending of the national emergency declaration at the southern border. So lots of executive actions already. I think after tackling some of those things, we're going to see some proposals on immigration reform. So I know that there's a proposed 8-year track to citizenship for about 11 million immigrants who are currently in the country without legal status. I think we'll also see climate change start to be tackled. So I know we've started dipping our toe in the water by rejoining the Paris Accord. So I think that's supposed to phase in over a 30-day period. And then Biden does have a goal of trying to be 100% clean energy economy with net zero emissions by 2050. So lots he's trying to accomplish within the first 100 days. You'll notice one thing that I didn't talk about, though, is probably tax reform. And I don't think that we're going to see that in 2021. I think that the juggling act with the fragile economy is still a little too soon to go and do some big reform on tax changes. So I think that's probably something we'll see in 2022, but I don't expect it in 2021.
Great. Thank you, Mike. So we've talked about 2020 and where it's brought us to today. We've looked at Biden's stimulus plan and kind of where we are in the process of reopening the economy. Based on what we know, how do we position for 2021, Robert?
Well, I would highlight, I'd look for maybe some value out there. It's been so spectacular for large cap growth stocks in the United States, the Googles, the Microsofts of the world. There has to be something that's cheap, and we always like to buy what's cheap because the way these cycles work, they come roaring back. And so I'm actually looking at international stocks. I'm going to highlight two areas. The first slide shows the last 20 years of using an American dollar to purchase, if you will, a dollar's worth of emerging market companies. And the historical average is you can buy it for 68 cents on the dollar. There are usually a discount associated with the emerging market stocks. And like some examples of emerging market stocks would be Jaguar Automobiles, which is actually owned by an Indian company. Hormel Meats is owned by a Brazilian company, and Hyundai Automobiles is actually a South Korean company. Those are emerging markets. And so historical average is 68 cents you can purchase, and through the end of December of last year, they're at 53 cents per dollar. And so you can almost buy emerging market stocks for half off. You contrast that with the developed markets. And so if you wanted to purchase the earnings of companies in the developed markets, and that's more of Europe and Japan and Australia, over the last 20 years, the historical average is 91 cents. You could buy it for about a 10% discount. But through the end of December of last year, it's about a 20% discount. And so international stocks are cheap. They're part of our portfolios at KWB. But if you're still working and still funding your 401ks, make sure that you've got some exposure to international stocks, or if you not, begin to have a contribution to the international area. And so that's good for the international stocks. And lastly, just one of the reasons why they've done so well is the next chart, which shows a 30-year activity of the U.S. dollar. So many of our clients have gone overseas cruising and vacations and whatnot. It's been rather inexpensive for Americans, especially over the last 10 years. The dollar's been so strong. Over the last 3 years, you go to Australia with a 40% discount and Canada with a 30% discount. And so once the U.S. dollar, I suspect, begins to weaken, the strength and the weakness go in 7 to 10-year cycles. And we're ending a 10-year cycle. As the U.S. dollar weakens, it's not all bad. If you're an American manufacturer trying to sell your products overseas, as the dollar weakens, those products become cheaper and you probably will sell more. If you're selling more products overseas, your earnings are going to go up, and so that's good for a couple of American companies. But it also means typically that international stocks and emerging market stocks in particular will begin to outperform. And so make sure that you got some exposure.
And Bob, that's where I go back to our January 2020 commentary where we said, if you're patient and you can handle some volatility, that emerging markets and international stocks would likely be the best place to be. For the first half of the year of 2020, definitely the U.S. outperformed, but in the second half, EM and international really started to catch up. So that goes back to being patient with stocks, and really hard to predict in the short term, but absolutely. This is, reiterating what we said about a year ago, and we still believe today.
Good, Kerr. I would agree. So good for international stocks, but I will also express a caution on U.S. Treasury bonds. This chart shows the potential impact. Obviously, inflation is kryptonite to bonds, and U.S. Treasuries in particular. The upper part of this chart shows what would happen if interest rates rose by 1% over a 12-month period. And it shows 2-year Treasuries, 5-year U.S. Treasuries, 10-year U.S. Treasuries. And just to highlight, a 1% increase because of inflation on a U.S. Treasury, 10-year Treasury means that you still get your interest, but the value of that Treasury investment is going to drop by over 8%. And if you had all your money in 30-year U.S. Treasuries, you're still going to get your interest every quarter or every 6 months. But the value of that investment, with a 1% increase in interest rates, your investments are going to drop over 19%. And so why would interest rates go up? I worry that inflation may come roaring back. Mike had mentioned earlier of under the Biden program, we may get another stimulus of $1.9 to $2 trillion. We may also get an infrastructure bill, additional spending for roads and bridges. If the vaccine rollout goes well and we all get our vaccines and start going back to work and shopping and traveling, the U.S. economy could begin to overheat. It's not a reality today, but that's one of the things that keep me up, that if the economy overheats and interest rates go up, the U.S. treasuries aren't going to do very well. So how do we diversify ourselves if you still need to be in bonds? Short-term bonds and lower quality bonds and maybe munis. This shows over the last, 60 some odd years what the upper chart shows what the interest rates on a 10-year treasury. And a 10-year treasury is really where mortgages are based off of. It peaked at a high interest rate in 1981 at 15.8%. Imagine investing in a 10-year treasury in 1981 and making 15% a year with no risk. Well, the problem with that is, as you see on the far right, you're now getting less than 1% at the end of December of last year on a 10-year treasury. Not much of a return. And so it goes back to, okay, if inflation isn't a problem and we keep lower rates for longer, we may have to revisit that 60-40 allocation of stocks to bonds. Maybe we need more stocks in order to be able to get a return. And so that's what keeps me up when it comes to the future and interest rates and inflation.
Great. Thank you, Bob. That was a great look forward. And to continue with that, we should look at the changes 2020 brought to our lives and what changes are here to stay rather than be a short-lived fad. Igor, what are the winners and losers of 2020, and what does it mean for the consumer trends going forward?
So 2020 started off great, where across the board, you saw a lot of winners in a lot of places. Now, in March, while most of the companies dipped, a few of them kept pushing forward, notably companies like Zoom, food delivery services, and eventually things like biotech and pharma companies started to pick up. We at KWB tend to look and ask ourselves what changes are permanent, what's going to be a part of our consumer spending, and just in general habits going forward. One of those things we think is going to be video communications. So COVID may have acted as a catalyst to boost the demand for Zoom, but we don't think it's going to go away. We think that that's going to be an alternative source of meeting going forward, essentially. And it also highlighted the importance of adaptation. Companies like Disney that were forced to look somewhere else, that now that their parks are closed, the primary driver of growth, they had to figure something else out. Or the companies that adapted, they came out with solutions. For example, Disney, they crushed it with their streaming services, and they're a serious competitor to Netflix. Now, other companies, they've been showing the trend of trouble over time. Look at traditional retail. Now, long before COVID, they started to kind of stoop lower and continue to decline, and this may have been the final nail in the coffin. But, well, the clear winner is the companies that are able to adapt. And just like the companies, we're always here looking and adapting to the markets and conditions for your portfolio.
Great, thank you, Igor. So with that, Carrie, can you give us a final few thoughts on what we may be doing for our clients and the ways we can help them get through, a potential correction, and maybe some of the things that Bob alluded to with the interest rates and declining dollar?
Sure, thank you, and thank you, panelists, for your input. I think the first and foremost, most important thing is investors really need to be patient and recognize that in the short run, things are very unpredictable and it's difficult to get all things right. But in the long term, again, mankind moves forward. Igor talked about companies adapting. Disney, when maybe not as many people come to the park, maybe they'll stay at home and watch various different shows and stream them. Netflix killed it, Amazon killed it, Walmart's really aggressively going after it. And you can get caught up in the day-to-day, but it's really important to really focus on, again, mankind, companies that are going to adapt, companies are going to be winners, and the future is still bright, as dark as it may seem to be at some points in time. I think the other thing is planning. One of the things that we've done in the last, probably 5 years is we've gone from maybe doing planning on a piece of paper to really some very enhanced optimization as far as looking into the future for people trying to make retirement decisions. In other words, what does my retirement look like when I'm out maybe 10 years from today? Am I on track? Am I saving enough? We also have a tool called Riskalyze, which enables investors to kind of deal with, well, how much risk am I comfortable with? If the market declined 10%, okay, no problem. If it declined 40, I'm going to lose sleep and do something that might hurt my portfolio. So one of the things that we've done is we've really tried to step up the planning, the projections, and scenarios. Well, what if I retired at 60 versus 65? What if I take my Social Security benefits 62 versus my full retirement age? So for those of you that haven't had some of those planning experiences with us, I encourage you to, talk to the wealth manager and make sure we're doing that for you. Sometimes maybe it's a little too far advanced. You're already retired and there isn't as much benefit. But boy, for the soon-to-be retirees and the new retirees, it's a great picture. And then I think consistency. Be consistent. If you're taking money out of your portfolio, don't take too much out. Don't constantly be coming in and picking at your portfolio. Don't constantly be in and out of the markets because that tends to hurt you. If you're putting money into your retirement plan, do it even if the markets go down. In fact, the people that are working, should still hope the market goes down because that allows you to buy more and more shares at lower prices. For those that are retired, of course, you don't want the market to go down. You want to be able to sell your shares at higher and higher prices. So there is a conundrum there. And then do the little things right. Keep adding to your accounts, like I said. Don't take too much. Take enough risk. And so that's where Bob highlighted, well, maybe 60-40 stocks to bonds isn't going to be good enough anymore if we have to make, 5 or 6 or 7% to be able to support ourselves in retirement. And then lastly, accept the volatility. Just realize that's part of the process. It's part of the game. In the short run, it can be scary, but in the long run, when you start looking at charts and history, there's reason to be optimistic and there's reason to believe that the long-term outlook is still pretty positive as we humans, move forward. And again, we're going to wake up thirsty tomorrow. So thanks for tuning in. And I think we're going to open it up to some Q&A.
Yeah, so we have a few questions here, but while they're kind of rolling in here, Rachel, can you go ahead and pull up the poll questions that were answered? So the first question here, under which president did the S&P 500 have the best annualized return during their term in office? And the answer is actually Bill Clinton. So it looks like 32% of us got that correct.
Right. And I think it was about 15% per year during his period.
Okay. And then this one was just more of a fun question. What activity have you missed most during the pandemic? And it looks like most of us have missed traveling, and I think here at KWB, the team can agree with you as well. Great. So I have a couple questions here too. I can quickly answer one or two of them for us. And the first one, do I have to submit the Form 309F that I received in the mail? Likely you received this form because somebody determined that you had some sort of interest in a company that was filing for bankruptcy. It would be hard for us just off that information to know whether or not you need to complete it. So it would be something that you could bring up with your advisor to determine whether or not you need to return it. How long is the $400 in unemployment benefit going to last? Now, I can give a quick answer to this. Mike, you can give more detail if you'd like. But right now, this is planned to continue through September of 2021.
Right. Yeah, that's what my research was showing too. So end of September.
Okay. Then, does KWB perceive the strength of the economy direction for 2021 will be COVID-19 vaccine rollout related? If so, to what degree? And if not, why?
Yeah, I'll chime in. I think you guys can hear me. Absolutely. If we have delays and issues with the vaccination and the rollout, then it is going to push out the growth of the economy maybe into 2022. We are seeing earnings picking up, and we are seeing the markets continue to pick up. We're seeing manufacturing picking up. And so that's all, based on, I think, a successful, somewhat maybe everybody being vaccinated by the summer. And so what could go wrong? Yeah, maybe the vaccine isn't as effective as we thought. Maybe it doesn't get rolled out as quickly as we had hoped. So absolutely, the rollout of the vaccine is going to have an impact on the markets for 2021 if it doesn't go, and it then might make everything we thought was going to happen in 21 actually occur maybe in 2022.
Yeah, and just to add on to Carrie's thought, the market works on expectations. And so the stocks have basically priced in the expectation that the economy is going to be reopening, probably not in the first quarter of this year, but maybe getting out into the third and fourth quarter. And so if vaccination rollouts are slower, if we see reopenings take longer, I think that the expectations that are built in the market now, the reality is going to be different and cause prices to probably go down. So yeah, expectation has a lot to do with the direction of the markets. And so it very much is going to influence what happens over the next couple of quarters.
Great, thank you. Another question here, will a $15 an hour wage, federal minimum wage, cause inflation?
Who wants to take that? Yeah, I think what's interesting is $15 an hour in LA and New York City is hardly nothing. Hard to live and maintain a halfway decent lifestyle. But if you're in Arkansas or Wyoming and some of these other places that are paying $7 or $8 an hour, definitely could be a problem for more regional type businesses and whatnot. For a lot, the minimum wage is just a starting point for your high school job. It's not designed to be a long-term income. It's just designed to be something where you start your job, you get some training, you work at Burger King or maybe a retail store or something like that. So, longer term, yes, I think inflation could be impacted. When wages start to rise, maybe companies won't hire as many people, and maybe they have to pass that price on to consumers. So if you're in the Midwest, used to hiring people at $8 or $9 an hour, and you have to pay $15, well, yeah, you're probably going to have to raise your prices at your local store or your, gun store or your, Jack in the Box or whatever the employees may be working and being impacted. So long term, yeah, I don't know as much on each coast where we're probably already at those levels.
Great. This next question I can just quickly answer. How soon can we expect to receive our 2020 tax documents? 1099-Rs from LPL are expected to go out at the end of January. So that's for your individual retirement accounts. 1099s, DIVs and miscellaneouses will be February and March in various rollouts. So unfortunately, those take a little bit longer. Bob, I think this would be a good question. It kind of goes back to what you were discussing a little bit. Would dividends be a better way to get income returns over bonds going forward?
That's an easy one these days. It sort of highlights, I had made a comment and Carrie had alluded to it toward the end, of going back to that allocation of 60-40 that we always like, 60% in stocks and 40% in bonds. But if the bonds aren't giving us any returns, we got to make up for those withdrawals that you're taking out. And that's where the dividend-paying stocks come into play. Now think about it. If a 10-year treasury is currently paying us 1%, maybe we'll look at those dividend-paying stocks, the Coca-Colas, the Exxons that are paying 3 to 4% in just dividends, much less if the stock actually goes up in value. And so it goes back to rethinking maybe the 60-40 isn't appropriate in order to make up for the withdrawals that you're taking. We may have to increase those allocations towards stocks to 65 to 70 to 75%. And one of the ways of doing that is by having maybe a greater allocation toward those dividend-paying stocks.
Yeah, and I think, Bob, Igor, what's the current dividend yield on the S&P 500 today? Just a little under 2 or?
Around there. Last time I checked, it was about
Terry, the last I saw this morning, it was about 1.9% on the S&P 500.
Yeah.
Under
Yeah. So you can buy the S&P 500 and collect 1.9 and have maybe growth potential, but then you have to deal with volatility. Or you can buy the 10-year Treasury, earn, about 1, have no growth potential, and still have volatility.
All right. Here's a question about small cap stocks. So I've noticed that the mid and small cap stocks have begun to outperform coming off the lows of the recession. Should we expect that to continue? It seems like large growth stocks were the place to be during the prior expansion.
I could take a portion of this. So it tends to happen in cycles. So one of the big things that KWB did back in 2019 towards the end was we actually trimmed our positions to small and medium-sized companies because we felt we were at the end or nearing the end of a economic expansion period. And so typically what occurs is there's more volatility in small and medium-sized companies. And when we're ending a growth cycle, you want to have a less position to those. And so now we've gone through a recession. Arguably, we're starting the beginning of the next growth cycle. And so usually the things that do poorly going into a recession tend to bounce back the quickest. So the coiled spring effect. So I think we're seeing a lot of that. We did see small and medium-sized companies get very dramatically impacted during COVID-19, and they have bounced back extremely quick. And so, yeah, at the start of a growth cycle, they do tend to outperform. And then as we get long in that cycle again, large US companies tend to be the outperformer again. So it just kind of goes in a cycle.
Yeah, and I think in the all-weather portfolios, we actually moved money out of large back into small. I don't remember what month it was, but that did occur.
Right, that was, I think, August.
Yeah.
Great. Mike, this is another question kind of lines up with what you were discussing today. You said that the next stimulus is $1,400 per person, $2,800 for a married couple. What about children? Do they receive anything? And then are the stimulus checks considered income and added to your gross earned income?
Okay. The stimulus checks, they did expand who's going to receive them in this next proposal. So, previously what was happening was you had to be an adult in order to receive it. And so they've expanded this to allow anybody who's basically a dependent status, even if you are an adult. So we are going to see more people who are just eligible alone for the $1,400. I think with children, the way that they're benefiting families is by doubling the child tax credit. I did mention that. And so right now the child tax credit is $2,000 per child. They want to double that to $4,000, but cap it at 8. So if you have 2 or more kids, then you'd receive the full tax credit. It would be refundable. And again, that means that if your taxes are reduced down to 0 and you still have leftover tax credit, they actually pay it out to you. So it would be almost another form of stimulus. So it is going to be a pretty big expansion of the program. They are trying to also get it to, they call it mixed status households. So people who aren't necessarily a citizen, but if you're married to a citizen, then you would also receive that benefit as well. In terms of taxation, yeah, I mean, they are added as gross income, and it is taxed at ordinary income rates. So just be aware of that when you do tax filing.
Great, thank you, Mike. So we just got a couple more questions here. If the virus variants increase and aren't affected by the vaccine, so meaning the vaccine doesn't prove effective with them, what happens then?
I'll take that one. It sort of alludes what Kerry had mentioned earlier, and Michael did too. The expectation is in the markets is that we'll have a successful rollout of the vaccine, which means we get back to traveling, we get back to spending and going out to dinner, and that's all very favorable for the economy. If that's delayed, then we may have a pullback in the market, which wouldn't surprise me. And if there are some variants associated with the vaccine, like there are with the flu every year, then our scientists need to get back to work in order to come up with some solutions. But we'll overcome this. The question is how soon? And obviously, the sooner that we can overcome it, the better for the economy and better for the markets.
Yeah, and I'd just like to chime in. You know, when those kind of events happen, you can determine and decide if you're going to be a victim or an opportunist. You know, if we would have all had the opportunity to go back in March of this year, I think March 23rd, and boy, put a lot more money to work knowing the outcome, we'd have all been, really pretty happy financially. So if we do get some pullbacks because maybe the vaccines aren't as successful or there's various mutations, I would encourage you to try to use that as opportunities, especially if you're a younger investor. Add to the portfolio. Don't stop, because we will get through this. There's no doubt in my mind. The question is it 6 more months? Is it 12 months? I don't know that answer. But again, in the long term, I know the answer. It's pretty predictable. So when life hands you a lemon, make lemonade. Be an opportunist, not a victim. It really is up to you how you handle it.
Great. So, Carrie, this kind of goes to what you were talking about at the beginning, and I think we went over it a little bit, but we can remind our audience here. So, at a prior in-person session, there was a historical slide showing that the market performed better when our government was split between the parties rather than having a single party majority. What are your projections for the impact of a Democrat-controlled Congress and executive branch?
Yeah, and I don't have those statistics right in front of me, but I think what we concluded is at the end, it really didn't seem to make a lot of difference whether we had a divided government, whether we had a all Democratic, all Republicans. I do think, if I recollect, it actually did best under a Democratic, more of a majority than the Republicans. And, I think that, like I said, with this sweeping of the blue or the Democrats, I don't know if it was I got the sun right coming in our office as our sun has started to move up. But I don't know that I think it was a sweep of the blue, a blue wave, so to speak. I think definitely things changed. I think, people weren't happy with, the prior administration. And, even though, and it was predictable a little bit, because I think we had said that if we had a recession, it's very likely that you would see a new president. And we had the recession. Now, and the other thing we said, if the markets were positive in the 3 months leading the election, might be the incumbent wins. So it was very close. I personally don't believe, I'm not changing how I invest due to, a Democratic-controlled House, Senate, and White House. I don't know if I answered that question or not, Quentin. Did I miss anything?
No, I don't believe so.
I'll chime in just a little. I think the reason why companies tend to prefer a gridlock situation, it's because they kind of assume nothing is going to change. And so again, it comes back to expectations. And if companies expect, big reform, but they don't necessarily know what it is, causes uncertainty. Markets don't like uncertainty. And so we like to see gridlock situations. The market tends to do better because, again, companies can, make projections for at least the next 2 years on business decisions. So, having full Democratic control, really what it's going to come down to now is, are there going to be moderate Democrat voters? Are there going to be some that vote more in line with Republican proposals or thought processes? And there are definitely some, especially the state of Virginia. So it's possible that just because, the numbers show equal number of senators, they may not vote completely along party lines. We'll see though.
And we saw that recently with Trump when he tried to do healthcare reform. There was a number of Republicans that did not vote along with the party. So just because we have maybe a majority of one party or the other doesn't mean, they always get their way.
Right.
Great. We just have one last question that came in here that I think we can get answered pretty quickly before we sign off. Mike, can a family decline from getting the stimulus checks if they don't need them?
Oh, that is an interesting question. I don't believe you can decline it, but what I would encourage you to do is maybe find somebody else who really needs it. So there's lots of restaurant owners or lots of people who do have small businesses that probably could use an extra boost. And so if you get it and you feel like, hey, I don't necessarily need this, it's just a good opportunity to be a good friend, to be a good neighbor, and to be somebody who's part of a community. So that would be my encouragement. I'm sure that if we look closely, we can all find somebody who still is in pretty big need.
Great. Thank you, Mike. And that is a great idea. All right. So with that, I want to thank you all for joining us today for our
Sorry, Quinn, to interrupt real
2021.
quick. I think there is one question that we may have missed from Otis about companies benefiting from pandemic that we may not have answered. Then I'd be glad to answer that one for you because I was thinking of a response in the meantime. So the question is, do you see any companies benefiting from the pandemic and are positioned for sustained growth post-pandemic? And that's something I actually look for often at KWB. Look for companies that are going to play more and more of a foothold in terms of how we do business. And there are definitely some that come out from COVID. Cybersecurity, that's one of the big ones that I could think of. With work shifting closer to your home and further from the office, the need for advanced cybersecurity metrics are ever greater than they ever were. And other places that may have a small correction in market price but continue to grow are things like Teladoc, Zoom. Now they've had a huge drive in demand due to COVID, but as a business model, hopefully they will last. They will continue to get business and kind of be part of the way we do business. Other things such as Apple and Amazon, they've been doing well, and I think they're going to continue to do well because they built an ecosystem around which they absolutely dominate. There's not much competition that you can have from. I can't think of a single product that will replace the Apple ecosystem successfully. And lastly, some things like solar that are maybe getting a little bit of an additional tailwind from Biden being in office. So maybe ESG investments, solar, and things around the home that will improve efficiency. So those are some of the things that I see maybe being picking up more demand and growing sustainably over time due to COVID.
All right, great. Thank you, Igor. So thank you all for joining us today. We hope you found some of the information that we shared with you helpful and intriguing. And as always, if you have questions about how what we discussed today may impact your personal situation, feel free to reach out to us, schedule an appointment with your advisor to go over your financial plan. And we look forward to having you join us in June or July when we do the next economic outlook. And thank you, and you guys have a great and wonderful day.